It's Wednesday, 3rd of June, 2026. Welcome back to your news update on Blip Brief, crisp but almost everything updated every market trading day. Yesterday's broader markets showed, well, some serious hesitation right out of the gate. But if you look under the hood, the tech sector was basically working overtime to drag the indices into the green. We saw the Sensex close up by 0.52% and the Nifty 50, that was up 0.43%.
Right, and the real story there was IT.
Exactly, the absolute standout. The Nifty IT index skyrocketed by an impressive 4%. I mean, that is its best single-day run in an entire year.
It is a phenomenal movement, especially for a sector that has been under, pretty intense scrutiny over the past few quarters. To understand why this massive surge is happening right now, you really have to look at a confluence of two major factors. First, we have a depreciating rupee, which dropped about 0.3% against the dollar.
There's always a currency play for IT, right?
Right. For India's export-heavy IT sector, the mechanism is straightforward. When you earn in dollars but report and pay salaries in rupees, a weaker rupee instantly translates to higher profit margins on your balance sheet. And you don't even have to sell a single extra line of code.
Sure, but I mean, a 4% jump requires something more structural than just a 0.3% currency dip.
It does. And that structural factor is the massive acceleration in enterprise AI adoption. We are looking at industry giants like TCS, Infosys, and Wipro. They are actively doubling their AI Copilot licenses for their own employees just within the last 6 months.
Okay, let's unpack this because I am always slightly skeptical whenever we talk about AI adoption as this massive market driver.
Understandably so.
Right. I mean, we have talked about AI as a theoretical growth engine for a long time, but actually doubling software licenses for hundreds of thousands of employees, that is real capital expenditure.
Yeah.
It signals that AI is no longer just a shiny prototype to show clients in a boardroom.
It's becoming the core operating model.
Exactly. But I have to ask, are we seeing the AI boom act as a sort of structural shock absorber for the markets? Like, is it masking the pain from traditional macro indicators?
Right.
It feels a bit like putting a high-performance EV motor into an old, rusted chassis. The technology is so powerful that it's dragging the rest of the market forward, even when the underlying economic fundamentals are struggling.
Look at the behavior of safe haven assets right now to answer that question. The broader market is actually quite anxious. I mean, gold saw an uptick of 0.79% and silver jumped 1.1%.
So investors are actively seeking shelter.
Yes. The AI software boom is providing a massive counterbalance, but the capital flowing into IT is highly targeted. It is not broad market optimism. It's a specific defensive bet on technological survival. Investors are parking money in gold out of fear and in AI out of necessity.
Which means the rupee didn't just depreciate in a vacuum. It's reacting to some very real, very physical supply chain and geopolitical tensions.
Precisely. The rupee slide is fundamentally driven by foreign investor outflows, combined with a sharp spike in crude oil prices. Over the last 24 hours, U.S. forces intercepted multiple Iranian missile and drone strikes targeting areas near Kuwait and Bahrain.
Wow.
Yeah. And furthermore, Iran has reportedly halted all ceasefire extension talks. This immediate escalation in the Middle East has pushed Brent crude prices noticeably higher. When oil gets expensive, India, which obviously imports the vast majority of its crude, sees its import bill balloon.
Putting immediate downward pressure on the currency.
Exactly.
And when Brent crude moves, the ripple effects hit the Indian economy almost immediately, but not always in the ways you might expect.
Yep.
I mean, the conflict in West Asia is completely reshaping global trade flows. Because traditional routes are compromised or deemed too risky by insurance underwriters, we are seeing a massive geographic shift. Like 80% of India's diesel exports have now shifted to Africa.
Moving entirely away from European and Asian markets. It is a staggering rerouting of energy infrastructure. You have tankers avoiding the Red Sea and Suez Canal bottlenecks entirely. And, it is happening alongside some very complex domestic consumption patterns. Look at the domestic energy data from May. We saw LPG sales drop by over 19%.
Over 19%. Wait, I'm stuck on something here. Why is there such a massive divergence? A 19% drop in LPG is huge, while petrol and diesel saw single-digit percentage increases in demand. They are all energy products.
Right, but this divergence tells us a very distinct story about shifting economic activity. LPG is primarily a household cooking fuel. A 19% drop points to significant changes in household consumption.
Like a tightening household budget.
Exactly, or shifts in subsidy distributions that are making families ration their usage. On the flip side, that steady single-digit growth in petrol and diesel, that indicates that commercial transport, freight, and logistics are still pushing forward.
Factories still need materials.
Yes, e-commerce still needs to deliver. So the commercial spine of the country is functioning despite the global supply chain chaos, even as households feel the pinch.
It is deeply ironic. You have global energy routes in absolute chaos, missiles being intercepted over critical shipping lanes, and crude prices reacting to every headline. Yet back home, the Reserve Bank of India is quietly stepping in to arrest the rupee's slide. They're basically acting as the silent guardian of the currency.
Deploying foreign exchange reserves, yes. Essentially selling dollars and buying rupees.
Right, to ensure that this global volatility does not entirely destabilize the domestic import bill.
And by artificially containing the rupee's depreciation, the RBI is preventing imported inflation, especially from that higher-priced crude oil, from bleeding completely into the domestic economy. If the rupee falls too fast, everything from electronics to fuel becomes instantly more expensive for the everyday consumer.
But it requires a delicate balancing act, right? Defending the currency burns through reserves.
Absolutely. If the geopolitical gridlock in the Middle East drags on for months, the RBI will face tough decisions on how long they can sustain that defense without broader economic consequences.
It is fascinating to watch how macroeconomic survival tactics mirror microeconomic ones, because the tension we are seeing in the global markets is completely altering how Indian companies operate on the ground. Going back to the IT sector, it is not just about adopting AI internally. It is about aggressive consolidation. I mean, Indian IT service providers are on an absolute M&A shopping spree, buying up smaller firms at a rapid pace.
But this is a defensive maneuver, not an offensive one. AI is creating immense deflationary pricing pressures. Think about the traditional IT services model. It is built on billable hours.
Right.
You charge a client for the thousands of hours it takes your engineers to write code, test software, or migrate servers. Now, automation and AI tools mean tasks that used to require 100 billable hours can be done in a fraction of the time.
So their core revenue mechanism is essentially eating itself. They're becoming more efficient, but they are losing billable hours in the process. That seems completely counterintuitive to growth. Shouldn't AI be accelerating their revenue?
It accelerates capability, yes, but it deflates the price you can charge for routine work. This is severely slowing down the organic growth of traditional IT services. So the giant IT firms are acquiring smaller companies purely to buy their client lists, acquire niche geographic presence, and secure market share.
Just buying revenue streams outright.
Because organic growth is becoming too difficult to generate in an AI-deflated pricing environment.
It's like buying the entire neighborhood just to ensure you get an invitation to the block party. You don't necessarily want to maintain all the houses, but you absolutely need the access they provide to new clients.
That is exactly it.
And if you are an investor right now, or even just looking at your own company's strategy, the message across corporate India is clear. The era of growth at all costs is dead. We are seeing a massive fever for IPOs and strategic pivots, all driven by a sudden demand for strict capital efficiency.
Investors are no longer willing to fund endless cash burns or capital-heavy expansion models without a clear, immediate line of sight to profitability. The cost of capital is too high right now to tolerate massive physical footprints that do not generate immediate returns.
Exactly. Look at the updates we received just over the last day. The Coca-Cola Company is uncapping its plans to list its India bottling business by 2027, aiming for a massive valuation while the market is still hungry for established cash-generating brands. Then you have Oyo's parent company, which finally secured SEBI approval for a huge IPO.
After years of waiting and restructuring their balance sheets.
Yeah. And perhaps the most telling pivot is Physicswallah. They are completely scrapping their capital-heavy push into physical K-12 schools, choosing instead to return to an asset-light, online-led model, strictly due to investor pressure.
Physicswallah's pivot is a textbook example of this new mandate. Running brick-and-mortar schools requires constant capital expenditure, real estate leases, building maintenance, massive logistical overhead. Investors looked at the margins of physical schools versus the scalable margins of digital platforms and essentially forced a return to the core business.
You build an app once, and you can serve 1 million students with minimal extra cost.
Exactly. You build a school, and you are capped by the physical space and high fixed costs. The market is actively rewarding scalable digital models and penalizing heavy physical footprints.
So we have India leading in software adoption, streamlining its corporate structures and deploying reserves to defend its currency. But here's where we get a major reality check. Despite India's industrial output growing by 4.9% and GST collections rising 3.2% in May, India just lost its spot as the world's sixth largest equity market.
To South Korea.
We have been leapfrogged. And I have to admit, this threw me. We just established that Indian IT is booming by 4% in a single day. How did we lose our global ranking?
The answer lies in the difference between adopting technology and manufacturing it. While India is leading the world in AI software adoption, which is exactly why our IT stocks are rallying so hard, South Korea is riding the massive wave of the AI hardware boom.
Ah, a completely different side of the same coin.
Right. South Korean chipmakers and hardware manufacturers are aggressively doubling their production capacity to meet the unprecedented global shortage of AI components, memory chips, and physical semiconductors.
So we have mastered the code, but we are missing the Silicon Revolution entirely. I mean, if we don't build the roads, it doesn't matter how fast our software cars are. South Korea's market cap, surging past India's, proves that the physical hardware infrastructure is where the premium long-term value is currently being assigned.
Software requires hardware to run. You cannot process billions of AI parameters in thin air. You need physical data centers.
Yeah.
And India is currently facing a severe talent crunch when it comes to the physical infrastructure of AI. We're talking about a massive shortage of AI hardware engineers.
Really, what kind of roles specifically?
This includes specialists in robotics, industrial automation, and the highly complex data center infrastructure required to keep these massive AI servers from overheating.
Overheating is the operative word there. I don't think people realize how much heat an AI data center generates. We are not talking about a laptop getting warm on your knees. We are talking about servers literally melting themselves into slag if the cooling systems fail for even a few minutes.
Exactly. The demand for engineers who can design and maintain these advanced cooling systems and physical architectures is so high, and the domestic supply so low, that salaries for these specific hardware roles are surging by 35%.
Wow.
India has built a global empire on IT services and software, but the next phase of the global tech economy demands expertise in silicon, liquid cooling systems, and physical data architecture. Without that, India is heavily dependent on imported hardware to run its domestic software innovations.
It is a critical bottleneck. You could have the smartest AI model in the world, but if you do not have the physical infrastructure to process the queries, the software is useless. But this hardware bottleneck brings us to a fascinating scientific breakthrough. If traditional silicon and electricity are causing massive overheating and energy consumption issues, what if we change the foundation of how computers process data?
The scientific community is already looking past the current generation of silicon for exactly this reason. The bottleneck you mentioned, the heat generated by pushing electricity through increasingly microscopic wires, is a hard physical limit.
Because electricity is just electrons moving through a medium.
Right. They bump into atoms, creating friction, which creates heat. You can only make a silicon chip so small before that electrical resistance generates too much heat to be viable.
And that is exactly what makes this new development so revolutionary. Scientists have just successfully developed a tiny, light-powered chip. Instead of using traditional electricity, electrons moving through copper wires, this chip uses atomically thin materials and nanoscale structures to generate, steer, and read information entirely using light, all within one single device.
To put this in perspective, this is a massive leap toward ultra-fast, energy-efficient AI and quantum computing. When you compute using photons, which are particles of light, instead of electrons, you virtually eliminate the electrical resistance that causes overheating.
Oh, wow. Because photons don't collide and create friction the way electrons do.
Exactly. This solves the exact energy consumption and cooling bottlenecks that are currently plaguing massive data centers.
So if data centers no longer need to dedicate massive amounts of their energy grid just to keep their servers cool, that power can be redirected to actual computing. It exponentially increases the speed and capabilities of AI models without requiring a power plant next door.
It is a fundamental shift in hardware architecture. Computing at the speed of light, quite literally, while operating at a fraction of the thermal footprint. It takes the physical limitations of current data centers and essentially bypasses them.
It completely changes the equation. I mean, we spend so much time analyzing the current constraints of our technology, like South Korea dominating silicon manufacturing. But innovations like this remind us that the playing field is constantly shifting. which leaves you with something critical to ponder. If the future of computing runs on light rather than electricity, the current geopolitics of silicon, rare earth metals, and traditional semiconductor manufacturing might be entirely rewritten in our lifetimes. Are we preparing for the right tech war?
And just before you go, quick note, this deep dive commentary was put together using advanced AI. We always strive for accuracy, but please do cross-verify any crucial information yourself. Your informed decisions are what matter most. The content shared here is for informational and educational purposes only and should not be treated as investment or trading advice. Past performance is not indicative of future returns. We are not licensed financial advisors.